Alright guys, glad to have you on board again. So today I somehow figured out that we have mentioned WYCKOFF patterns quite a lot in this channel's history without ever taking the appropriate amount of time to fully review what needs to be taken out of these patterns. I've seen them over and over again throughout the ages, and just like there are rolling patterns of individual interest into some specific strategies like that, like WYCKOFF had its time, Elliott wave has it well, and all of these strategies have something in common. They all are somewhat very good elements in and within those strategies, but most of it is pretty unreliable because it's due to some shady or unconventional factors that rely into a lot of subjective analysis. That means, well, in terms of learning technicals and stuff and learning rational type strategies to guide your decision making, these strategies are generally used by unexperienced retail traders who are trying to extract the magic out of this. And this is where it all stops, because frankly speaking, there are very good stuff to be taken out of both WYCKOFF, Elliott wave, and it goes as well with Ishimoku or whatsoever, but they all tend to go into over complexity at some point, which totally destroys the actual net benefit of this. So I think all of these strategies have good elements, but they are very bad strategies as a whole. So I'm going to explain today what needs to be taken out of WYCKOFF, as it is not a single kind of strategy that you can learn and profit out of just like that. But there are still some intrinsically very good elements to take out of this. So kind of extracting the essence of WYCKOFF is what we're going to be doing today. So the number one thing that we need to talk about is the number one misconception I see with WYCKOFF pattern. By the first one being, they don't occur everywhere. They're not that kind of pattern that you can navigate efficiently. These are generally not technical patterns. This is kind of the opposite way around. And that's where we dive into net subjectivity for WYCKOFF. A hell of a lot of what defines those patterns is subjective by nature because it's related to psychological states. But there are some things that need to be verified still, and that's the reason why I think it's a very good strategy. It's just that people take it 180 degree around. They tend to say the psychology derives from the technicality of these patterns, and then they tend to look at the technicals to justify some things, where this is exactly the opposite way around. It's generally a psychological mind state that will put you into the right track to eventually go along and verify the existence or not of a potential WYCKOFF pattern. It's really the other way around. It's when you feel the pattern that you're going to have to verify its previous technicality, and not the other way around. I see people trying to forecast WYCKOFF patterns and their early stages, and we're going to see that this is pretty hard to do, not to mention this is going down to very down speculative rabbit hole. So the first element we would all gonna have to agree upon today is that despite the multiple patterns that you will see, there is lots of subjectivity along with them because it comes to assessing the market psychology. Both your own, like the individual trader's market psychology, and the global market psychology, the psychology of multiple uncorrelated individual making individual decisions on their own based on their own vision of the market. And that's the number one thing to say. I generally see as well people saying WYCKOFF is a manipulation of smart money against dumb money. That's nothing like that. A WYCKOFF pattern is somewhat creating that transfer of wealth from unexperienced hands into generally more experienced hands, but that's more of a consequence rather than a cause. The cause comes from taking out of WYCKOFF's vision of the market, the coalition of these experts' hands who will all face the same problem. No one knows anything about the market. The uncertainty is what drives the market. And smart money individuals are feeling that uncertainty as well. What drives a WYCKOFF pattern is that in those specific moments, they will tend to have similar reactions. Like more experienced hands will tend to behave the same way. That doesn't mean they communicate with each other to manipulate the market, which sometimes people tend to feel like it is. It's not. It's just these guys will have natural responses that are similar. When on the other hand, an experienced hand will have radically opposite reactions, and this is what happens. So this is not a clear manipulation, tinfoil hat stuff, whatever. It's just the inexperience of some facing the experience of others. And it's generally psychology that makes the difference between the two. So there is a lot of psychology involved into WYCKOFFs. Okay? what drives that psychology, we're going to see it through, but because it comes from different phases. And that's the number 2 mistake that I see in WYCKOFF. People trying to copy-paste from the actual price action in here, trying to basically say, yeah, the price has done this, then that. So if I copy-paste this on top of this, that definitely means there's a WYCKOFF at play. No, it's not. No, like I said, WYCKOFF is primarily a psychological pattern. So you need to feel the emotion. You need to feel the mind state, the distortion of the perception in the market, to say there is likely the good primitive for a WYCKOFF to experience. What we're going to see here is that the psychology definitely is based upon time. It's definitely a time variable that's at play in WYCKOFF. And to understand that, it's not by looking at the swings that the market is doing, all these so-called SOS, SD, phase B, and whatsoever. It's not what defines an actual WYCKOFF pattern. It's generally a phase-based stuff. And that's what people rarely take out of, because the essence of WYCKOFF is really there. All WYCKOFF patterns are defined by 5 phases, A, B, C, D, and E, okay? They all, as you can see, are reverse versions of the other. That means the accumulation is the reverse of the distribution. This uses somewhat different names, but this is just basically asymmetry. What would have in here is a variance. That means accumulation patterns in here, building bottoms, have 2 variations, okay? Just like the distribution has a variation as well, okay? So 2 variations. And then there are the reaccumulation and redistributions, okay? Which are basically continuation patterns that looks utterly similar to the previous ones. So the difference in here are very, very straightforward. If you pull it out and take the essence out of this, basically A sections of both variations are exactly the same, okay? The opposite version are just the mirrored version of the first one. So basically, WYCKOFF, when you're trying to figure out whether you're in schematic 1 or schematic 2, don't even think at displaying these 2 ones in the early stages. There will be definitely the similar ones. So the earlier conditions of WYCKOFF are the same, be it version 1 or 2. They don't really matter at that stage. The point B are quite radically similar. They're like the same ones, basically. So when you go out of phase B, okay, these 2 patterns, be it schematic 1 or 2, just looks utterly the same at this point on. Okay, this is where you'll see the first divergence, okay, with the reaccumulation or redistribution, okay? Like as you can see, phase A looks exactly the same, whether it is a redistribution that will end up with a negative outcome or an accumulation will end up with a divergent outcome and a reverse on the market, okay? So the difference between the 2 is there's no way you can tell the difference in phase A, okay? Phase A is characterized by a psychological mindset, which is important. It comes out of huge, volatile, and volume-driven markets, which ends up with a selling climax or buying climax on the opposite direction. That means huge volumes, huge volumes, which is generally followed through by an AR, automatic rally, which is just a V-shaped reverse coming out of this. You don't want to see a rounding bottom or a hesitating bottom in here. It's clearly V-shaped reverse. It goes from bearish to bullish, just as the way it is. And these 2 levels themselves will define the support and resistance of the pattern, okay? The preliminary response of the automatic rally defines the resistance or support in the opposite way around, okay? That's critically important. And the selling climax or buying climax defines the other boundary. And then the market will stay within those boundaries for 90% plus of the time, all right? That's important for you to understand. The thing that comes out of it in phase A is that there's a secondary test, which is mandatory. There's no way it doesn't happen, all right? That means after the automatic rally, the market reverses one more time and goes right back, not testing the selling climax, but getting close to it. There's a secondary reaction, secondary test, and this closes phase A. That means after the market goes straight line bunkers, automatic rally, and secondary test concludes, you will finish the phase A. So phase A is characterized by high volume, high directional throughput in the prices, and then start beginning of a neutralization that comes in 3 phases: a climax, an automatic rally, and a secondary test. All right? That's important for you to understand. These patterns, of course, happen out of massive support areas, and they generally tend to break the technical support. That means this is where generally we see this as a preliminary support. That means there is a technical support visible by the market that's going to be broken through. And the accumulation is generally going to happen across this level, across and below, not above. So it's generally breaking a visible level of support. That's all the element that characterizes phase A. Excessive market, highly directional, and then this kind of three phases that happen that neutralize. And they set the significant levels of support and resistance that will be held during the entire pattern duration. Phase B is contrary into that. That means the volatility is going to be destroyed. During these phases, both the resistance and support will be tested and rejected. That doesn't necessarily mean that ST phase B has to break the lows or the SOS has to break the resistance. They just need to get back there and test those levels again. Okay, so that's the first thing. If you try to copy-paste the technicals of things, well, sometimes the SOS breaks, sometimes the ST phase B breaks, but not all the time. So how the hell do you figure it out? Take the essence out of it. Don't try to make it overcomplicated. Phase B has to test both the support and the resistance at least one time. Can happen multiple times, but the B characteristic, it does distort time. Phase B is the longest of all, okay? It takes the freaking long time to build phase B. It's generally characterized by apathy in the market. The market just destroys volatility. Following on from the very volatile phase A and its large swings, now the swings are narrow, there might still be some acceleration, but mostly overall the volumes are neutrally tainted. They go down and it feels like time has frozen. Despite some peaks of volatility when the market trades at the resistance and support level, nothing ever happens in the middle. It's very boring, the volumes are destroyed, and phase B lasts for a long time. The market has to switch in this apathetical mode, which means following from the explosion of volatility, now the volatility has significantly contracted, whilst failing consistently to break out of the range after multiple tests. Needs to be at least 2 tests of the supports and the resistance, or one of each, okay? Could be multiple, but at least one. That's the way to go. But B phase is mostly characterized by the destruction of volatility. The swings gets non-existent, and as we get to test the volatility boundaries, as we get to test the range boundaries, rejections happen all the time, until apathy totally drives the market sentiment. When comes the phase C, which is the turnover point. This is the first moment in which you will see a distinction between phase 1 or schematic 1 and schematic 2. So that's at point C that you will see, and only at that point you will start to figure out the difference between the two variants, okay? There might be constituted by 2 different patterns. The first one is there's going to be a spring that has to break the range, okay? The spring needs to go down the supports and breaking a support to get to this, followed by a test, which is generally after the liquidations will happen a retest of one of the supports, which is going to be positively oriented this time around. The support will going to be recovered. Okay, and it's important to have these 2 tests, okay? First break, second test. It's important to have that around, okay? It's generally when the weak hands get liquidated. Those who overexpose themselves in the late B stages, basically in here, they're so sure this thing is going to explode that they're over-leveraging their trades, putting stop losses that will gradually over time raise, because of course the cost of capital is going to bring them at a closer edge to liquidation prices as the time passes. As remember, time is the variable in this equation. Though most of the retails will get over impatient, they will over leverage their trades or just simply overtrade, and by that they will raise their liquidation threshold until at some point the smart money is incentivized to just take it all down and buy their losses. This is the final transfer of wealth. Phase C is characterized by this. Phase C is the last point of transfer. That means most of the pattern's volume has been transferred already. It's just a final remaining stage before D and E, which are the same in both cases. So the only difference comes from phase C. And the phase C can take 2 variants. If for whatever reasons the smart money sees that the retailers are over leveraged, they will go and liquidate them to build a massive support which they're going to create the reversal out of. On the other hand, if the retail crowd is capitulating, aka selling, because they are too much or they anticipate that the market is going to break down, then this is where the smart money just buys them out of nowhere. Just constantly buying, then finalizing the transfer of wealth. When the supply gets to be diminished enough, phase C concludes and D and E reveal themselves. That means those who failed or decided to exit the market because of too much apathy, they bought in, they wanted the rewards to come quickly and they did not. They suffered too much psychological pressure, they capitulated. This is where the smart money buys them without even going for a spring. And this pattern exists. How do you differentiate between variant 1 and 2? There's no way you can do it. Only the market makers can eventually do it if they look at the order flows themselves. And mostly you need to understand that market makers don't see the whole picture. There are multiple of them, and they need to try figuring out what the others are doing as well. Remember that no one is in control in these patterns. Wyckoff puts pressure on everyone. But there is a nasty tendency to say that the retail and unexperienced traders generally tend to crack there or get liquidated in the spring. While on the other hand, the smart money takes the message. As the time expands and the volatility reduces, as the volume cools down, we all take the message. That tells us, well, okay, we're going to step down a bit, verify the prerequisite of this pattern, and if it's valid, and if it's on a visible, clear level of support, we're just going to stop speculating. We're going to let the time play its variable. We're going to cool down on this time constraint, stop leveraging the trades to have to suffer from interest rate payments, and so we're going to avoid having tight stop losses being available to liquidations or stuff like that. And we're just going to let the thing behave, not necessarily trying to profit from it. We're just going to let the time pass. And that's what clearly differentiates the psychological mindset of this pattern. Every experienced trader knows that it needs to behave, where on the other hand, all the unexperienced retailers will trigger decisions. And that's the characteristic of phase C. This is where the last capitulation event happens, the last transfer of wealth from weak hands to somewhat stronger hands. And then DNE reveals the pattern as it was. So there's two things to take out of this. Try not to fall for phase C, and when the phase D and E happens, everyone is agreed to this. That means phase D is generally back to consensus. We go back to the previous resistance. There's a sign of strength because this time around it feels like, yeah, the trap is even more evident by the day, and it feels like those who were wrong-footed in here are going to have to buy again. And when they have to buy again, all the supply is being transferred into the hands of the smart ones. And when the weak hands after buyback from the smart hands make them pay for the expense. And that's the way to go. It just means we have the supply, you don't, you're going to have to buy back from us. That's the way to go. This is just a simple transfer of wealth that is due to a psychological mismanagement. The second thing to take out of this is that everyone agrees at the end of the pattern. Where it's difficult is this huge level of disagreement that comes from late stage B and stage C, where most of the wealth transfer happen. As we're talking about generally small hands shaking and falling for the traps of longer term, deeper pockets, that's generally transduced by a low volatility and low volume transfer. So you might not want to see an explosion of volume during the spring. That's generally the opposite. But this is where phase C is characterized by rising volume against the contraction of volume that is phase B. So phase C is the last transfer of wealth, which should generally be translated by slightly higher volume. Not an explosion of volume, but volume will start to increase when either we get to the spring liquidation or the lowest point of support. Don't try to anticipate whichever of those two is going to play out. Just let yourself get through it. Phase D and E should recorrelate everyone to the same conclusion. We have built a massive bottom structure. One certainty out of this is whether you had a spring or a lowest point or a last point of support, both cases will trigger some unstoppable low points where you can safely put stop losses below. That means you can put your stop loss below the last point of support, just like you can put safe stop losses out of the spring. Though that's how it goes. When the pattern completes, everyone will see the picture. It will look as evident as it could be, and everyone will put their stop losses out of there. But this time around, the supply has been accumulated, so there's no way around some kind of a nasty shadow candle will come and stop everyone, because now the supply is in control of strong hands. That's what it does. Now for the difference between the accumulation and redistribution come from this area. Generally, the redistribution shows volume going down, but not the volatility. There's generally intrinsic volatility in phase B. The phase B is characterized by the fact that this time around, the smart money is trying to shake the weak hands to provide the missing support, the missing supply. But on the other hand, generally, in terms of redistribution, that means the smart money is trying to get rid of the excessive supply they have, and they're trying to figure out weak hands to buy them. And that's a significantly different kind of pattern. That means in this structure, the smart money is trying to liquidate the counterparty hands. When on the other hand in here, they're trying to get them in. They're trying to get them to buy the breakout so that they can finally get rid of the remaining supply. It's really, really critically different. In here, the pattern is maximizing volatility to get to attract the weak hands into buying at the boundary of the range. But it always comes out of this phase distortion of time, phase B. Phase B is characterized by lowering volumes, but increasing accumulation and volatility when it comes to the redistribution. That's generally the sign that the smart money is trying to get rid of their supply or trying to accumulate more on a limited availability. And that's really how it goes. There is little demand here, so the smart money needs to get to some tricks to figure out some buyers. They need to attract them. When on the other hand, that's the same thing goes in here. They need supply and they can't find it, so they're going to try trapping you into selling it below the support, where they will be more than happy to take it. So both of these structures are generally characterized by a huge transfer of volume in the spring or UTAD in the opposite version. That's really critically for you to understand. It's generally looking exactly the same on preliminary phases. It's just late stage phase B and stage C that the differentiation between all those patterns occur. On the early stages, there's no way for you to differentiate them. The best you can get out of the guessing this is coming out of the technical area in which it plays out. For example, remember what you want to see. Bitcoin has been at play for a huge WYCKOFF accumulation here. We've retraced to some major support in here, broke it down, and accumulated below. You see those horizontal lines, and if we were zooming in, you would see the automatic rally, the secondary test, and the rejection of the resistance. The spring happened in here, and the last zone of support was there after the market reversed. You could zoom in into the lower time frames to see exactly how it happened. I've seen so many people say here was a distribution. Frankly speaking, in the rationale of WYCKOFF, it wasn't. The patterning here didn't complete as it was. You don't see these horizontal lines of support and resistance as per the requirements. Just as I've seen people saying there was an accumulation there. No, there wasn't. You don't see this horizontal line of support. So don't try to put WYCKOFF everywhere. It's not because WYCKOFF predicts all accumulation. WYCKOFF is a strategy. That's a strategy that doesn't exploit 100% of market moves. Some accumulation might not follow the WYCKOFF narratives. But you, as a trader, need to define clear rule sets and follow and abide by them. So like we stated, you need to use WYCKOFF in certain areas. One thing you know is that accumulation and reaccumulation don't happen in all-time high territory. They happen in already traded areas. So for example, right now we're in Bitcoin, and that's the last area in which we can trade potential reaccumulation. If Bitcoin goes higher from now on, there will be no other reaccumulation in the distance because we will be trading in historical prices. Here is the last time where we had a significant resistance good enough to create those horizontal level out of a technical level that is visible. So here's the last area in which we can create those reaccumulations. Okay? That's very important for you to understand. Don't look for reaccumulation in tradable all-time highs prices. Okay? That's really important for you to understand. The distribution pattern always happen in either clearly visible resistances, okay, or all-time highs. Same thing goes for the accumulation. They happen in clearly long-term visible support areas and at historical all-time lows. Okay, that's important for you to figure it out. The number one structure in the pattern is the distortion of time coming from the hugely volatile phase A. So if you see a WYCKOFF pattern, you need to see volatility as you get into the area. And then the time volatility destruction. It just expands time as the volatility contracts. You need to see multiple tests of the supports and resistance building horizontally. There's no dynamic wedge pattern, whatever stuff. It's just going flat. And there are multiple tests and retests of both boundaries as the time variable is played critically. This is the time variable in the pattern that creates the variations between phase C, which are just the termination phase of the transfer of wealth that has happened all throughout the phase B and C. Once the phase B and C are terminated, the market will go back to some more consensual terms where everybody will start to agree upon the fact that a major bottom or a major top has happened. And the pattern resolutes itself with a volatile explosion. At the end of it, the volatility resumes. So that's what defines a Wyckoff pattern. You get in with volatility, you get out with volatility, and the volatility gets destroyed in between, following these multiple tests of supports and resistance and this huge psychological shift. At that point on, you want to see the retails doubting like crazy. Otherwise, the Wyckoff isn't playing its game. And that's important for you to figure it out. There is a huge psychological impact that needs to be part of the pattern. If you don't feel it, that means it's not there. So that's important to say, to terminate. Even professionals will feel the distortion and the urge to trade, or the anomalies, like why the heck is it taking so long, is exactly what you want to feel as a trader to say that there is likely chances for a Wyckoff to be at play. And when it does, verify the technical elements that must proceed. At that point, you're generally late phase B or early phase C when you're asking yourself these questions. If you can verify all the stages of phase A and B, then you can apply the psychological mind state of a Wyckoff pattern, which is not trying to figure out if there is going to be an LPS or spring, not trying to profit from the pattern, but trying not to get flowed by it. Not trying to fall for the stupidity narrative of over-leveraging the trades or trying to control time. Time is going to fuck you up. Don't try to predict it. Be patient, resilient, don't overtrade. Don't raise tight stop losses. Don't put yourself into a potential liquidation system. Wait and let the time play its game. Understand that neither you or none of the involved party in the system has control. It's a pattern that needs to be recognized at doing exactly the opposite. Letting go is all you need to do in a Wyckoff pattern. Try not to use time or technical patterns to figure out what the market is doing. Try to get rid of it and get to the easiest part of it. The market may test the bottom once again, but you don't know for sure. So don't be among those who will wait below this bottom, because you might be left aside. So you're going to have to figure out how to expose yourself. If you're already exposed, just patiently wait. There's no way for you to know which one of these variations will exist, and no one knows, not even the market makers. So that's really how it goes. It's an unpredictable pattern. Most of the people try to take advantage of it, and they generally end up being flowed. On the other hand, it's a highly psychological pattern that plays around the #1 bias of unexperienced traders. Their fear of uncertainty, they're trying to gobble it up by putting some weird and wild pattern all over the place. Where on the other hand, this is just a simple fucking horizontal support and resistance stuff. So make it easy on you guys. Don't try to pull some weird technical stuff or correlation or whatever I see out there. Just try to make it easy. It's just in your head. There's no way for you to move anything. Wait until the market gets to the boundary. If it's an accumulation, the spring will get rejected. And don't try to be there with a stop loss. If the market has sufficient support in here, it will figure out a higher low. And if you're waiting below the support, you'll be left below. So that's really how it goes. There's no way for you to catch the bottom on this pattern. There's no way for you to differentiate between the reaccumulation and redistribution, the accumulation and distribution patterns, but by looking at the area of prices in which this happens. Okay? The technicalities in here are pretty damn subjective. They require analyzing both the psychology and the volume, but most importantly, these two things happen in different areas. Okay? Generally, the accumulation and reaccumulation happen in areas in which technicals are not very attractive. They generally happen in very tight supply, where the market makers need to either get rid or replenish their supply in a very limited statement. That's the reason why I think there's definitely all the prerequisite for an accumulation pattern right now in Bitcoin. If you see a hell of a lot of available supply, fuck no, not a chance this could be a reaccumulation or redistribution. Okay, guys? I hope you would understand that by now. You know everything there is to know regarding Wyckoff now, okay? It's not a precise technical pattern. It's quite the opposite, actually. That's the reason why I don't like when I see non-experienced retail traders using Wyckoff all over the place. It's generally a pattern that everyone feels, experienced traders as well. And it comes with the experience of feeling those sentiments of this takes too long. This should have responded by now, and all of these impatience biases that tells the smart money that at this precise point in time, a Wyckoff pattern might be at play. So when you see people trying to figure out the existence of a Wyckoff pattern on the early stages, that can be just either highly speculative. Just like I told you, I clearly insisted on the fact that I think we have the prerequisite for either an accumulation or whatever. I never said it would be. I'm saying so long as we don't break the horizontal support and resistance of Bitcoin right now, we would be in the potential accumulation. I want to see the price distortion, and we're not yet there. Definitely not yet there. All right? It is a price-time manipulation pattern in which the smart money knows to just step back and relax, where the retails will fall for the traps because it's too much for them to handle. But I want to see them under pressure. If I don't see any of it, if I don't see the hesitation and impatience in the market, I don't think any Wyckoff is a play. Wyckoff inevitably comes with a high level of psychological management. Okay? And the only way you can profit from it is just not to fall for it, not trying to beneficiate it by predicting where the top or bottom would be. There's no way for you to figure it out. The variations are here to trap you in. Just like when I see people pulling Elliott waves all over the place in ranges. It just makes no sense. So just use Wyckoff in appropriate context, please, and understand that it is mostly there to tell you that you need to behave correctly and not falling for the traps instead of trying to predict. Okay? It's more a pattern of letting go rather than trying to take control. All right? I hope you know everything by now. See you guys later. Bye-bye.